Assalamu alaikum. Hi guys, hope you are fine. Let's start today's chapter. That is chapter number 11. And this is in continuation of our understanding regarding balance sheet. We have studied assets and we have studied liabilities. Now we are going to the third segment, that is stockholders equity, in which we will learn what is share capital structure, how they are available for the assets of the company, and what are the rights of shareholders or stockholders, what amount they contribute to the business, what is retained earning, and so on. The main features would be study in this chapter is discuss the advantages and disadvantages of organizing a business as a corporation. We know there are certain types of businesses like sole proprietorship, partnership, and a corporation. So here we will discuss the advantages and disadvantages of organizing a business as a corporation. Then we will distinguish between policy owned, publicly owned, and close held corporations. What are publicly owned corporations and what are closely held corporations? These are usually called private limited companies, and these are public limited companies. Next is explain the rights of stockholders and the role of corporate directors and officers. We will see what are stockholders and what is management of the corporation, how the business is being managed by the corporate directors or officers like CFO, CEOs, etc. Treasurer. Account for paid in capital. We will learn how we will do accounting of the paid in capital and prepare the equity section of a corporate balance sheet. In which we'll cover what is the opening balance of the capital, how much further raised up or the shares are converted into equity shares, and how much the retained earning has been increased or decreased due to a payment of the dividend. Then contrast the features of common stock with those of the preferred stock. There are two types of stocks. There is common stock and a preferred stock. Then we will discuss the factors affecting the market price of preferred stock and common stock, how the market price has been determined in terms of both stocks, and then explain the significance of book value and market value of capital stock, why there is a difference and what are they implied book value and what is the implied market value, what is the benefit of these two, and how we will value the capital stock and ultimately the organization. Explain the purpose and effects of a stock split. We will learn stock split as well and account for treasury stock transactions. Treasury stock are those transactions in which company buys own shares from the open market. Okay, let's start with the first question, that is advantage and disadvantages of organizing business as a corporation. Let's see what is corporation. As we have mentioned, there are certain types of businesses: individual or the sole proprietor, then is the partnership, and third stage is corporations. Corporations are usually formed to raise a huge amount of capital from the shareholders. Okay, the owners of corporations are called stockholders. In small corporations, there are only one or two stockholders. Maybe in a closed corporations, which is called private limited company, you may have a seven stockholders. But in a public limited company, there may be a millions of stockholders. Okay, the stockholders are real owners of the business. Let's see. A corporation is a form of business organization that is recognized under the law as a separate legal entity. This is a separate legal entity apart from its owners. This separate legal entity has its own rights and responsibilities, okay, apart from those of its owners. The assets of a corporation belong to the corporation itself, not the stockholders. There is a certain corporation, it has its own assets, own liabilities, own equity. The corporation is responsible for its own debts and must pay income tax on its earnings. As a separate legal entity, a corporation has status in court. It may enter into contracts and it may sue and be sued as if it were a person. So it is not a human being, it is not a human individual, it is an artificial person created by law. And how it is created, we will learn in a short while. The how corporations are incorporated, how corporations are born, and so on. Okay, let's discuss the advantages and disadvantages of this corporation. First advantage of this corporation is that the stockholders, that the real owners, are limited only to the extent they have put in as a capital. They are not personally liable for any debts of the company. They are not personally liable for any debts of the company. Their liability is only to the extent of the amount contributed by themselves in the company. Okay, as an owner, stockholders are not personally liable for the debts of a corporation. This concept is called limited personal liability and often is cited as the greatest advantage of the corporate form of organization. Okay, let's first discuss the advantages, then we will move to disadvantages. Transferability of ownership. In corporations, transferability of ownership is very easy. You can sell your shares anytime and you can rebuy those shares anytime through a stock exchange in which these shares are listed. Okay, professional management. In corporations, since there is a much amount of capital is available, you can hire professional management. Whereas in private business, partnerships, or sole proprietor, if you have to hire professional management, you need a lot of resources, which these types of business, sole proprietor or partnership, hardly finds themselves to hire such a huge professional management at high prices. That's why that is their disadvantage, and this is the advantage of corporations that they can hire professional management. The stockholders own a corporation but do not manage it on a daily basis. To administer the affairs of the corporation, the stockholders elect a board of directors. The directors in turn hire professional managers to run the business. So stockholders cannot run the business. They select among themselves a certain board of directors, and then that board of directors hire professional management managers to run the business. We will see it in further details, uh, inshallah, during this lecture. Continuity of existence. This form of business, that is corporations, usually continue for indefinite period, for 100 years, for more than 100 years, and so on, because the retirement or the death of individual stockholders does not seize the company. It This company will continue. The successors of those stockholders will get the shares and the company goes on. Whereas in the form of the sole proprietor or partnership, whenever any partner deceased, the partnership dissolve and the continuity of the business is challenged or at stake. Okay, these are four advantages of the corporation that make it very popular to form a business in the form of the corporation. The disadvantage is heavy taxation, or it is called double taxation. The scenario is that whenever companies earns a profit, it has to pay tax. And when this profit is distributed among shareholders or stockholders, they also have to pay tax being their personal income. It means first the corporation will pay income tax on its earning, and when this earning is become the dividend of the shareholders, they have to pay income tax as well. This is the disadvantage of corporations. Okay. Plus other disadvantages, since it involves public and government being the regulator has to regulate these businesses through greater regulation. They they raised certain obligations, certain filings, certain regulations so that they report on periodic basis to the Securities and Exchange Commission of Pakistan or other government agencies to to have a fair dealings with organizations, with the stakeholders, and so on. This segment is also covered in a little detail when we will see they have to maintain independent accounts, they have to audit those accounts, and they have to comply certain forms and regulations. Otherwise, the management may face certain penalties or it may raise to their imprisonment. Okay. Cost of formation. Since this is public domain and you have to prepare certain documents which may be costly, you have to prepare certain deeds, stamp papers to have acquire stamp papers and to register a corporation with Securities and Exchange Commission of Pakistan or Securities and Exchange Commission of United States or any country, the cost of the formation is usually high. An unincorporated business can be formed at little or no cost. This is incorporated form. That's why you have to pay certain fees and you have to pay stamp duty charges or etc. Forming a corporation, however, normally requires the services of an attorney, and you may hire a professional consultant or a attorney or lawyer to prepare your documents, and it may cost you heavily. Separation of ownership and management. Here, the ownership and management is separate. Ownership lies with the stakeholders, whereas the management lies with the professionals hired by the shareholders through directors. So this is the disadvantage of corporations that owners cannot run itself the business of that corporation. Okay. So the limited shareholder liability, transferability of ownership, professional management, and continue of existence make the corporation the best form of organization for pooling the resources of a great many equity investors. तो हमने ये एडवांटेजेस देख ली बेटा. लिमिटेड शेयर होल्डर्स लाइबिलिटी, ट्रांसफरेबिलिटी ऑफ ओनरशिप, professional management, and continuity of existence makes the corporation the best form of organization for pooling the resources of a great many equity investors. Okay. Why business incorporate? Why we go for corporations? Why we incorporate the business? The first thing is limited personal liability. Here's the liability of the stakeholders is limited to the extent they have put in as a capital. Their personal liability is not, their personal property is not at stake in corporations. Whereas in individual business, that is sole proprietor, or in the private partnership business, their liability is to the extent the assets they own. This is not restricted only to the extent of the capital they contributed. This simply means that the shareholders are not personally responsible for the debts of the corporation. Thus, if the corporation has financial problems, the most that a stockholder usually can lose is the amount of his or her equity investment. Suppose you have buy a shares with rupees 100, and if company dissolve and company going liquidated or bankrupted, your 100 rupee investment is at stake, not anything else as at stake. Okay. And second advantage is that for a large company, it makes ownership of the business highly liquid investment. Whenever you want to sell your shares, you can sell those shares at the organized securities exchanges. Like in Pakistan, Karachi Stock Exchange, Islamabad Stock Exchange, now it is called Pakistan Stock Exchange. Whenever you want to sell the shares, you can sell at any time. And anytime you want to purchase, you can purchase it. So in a corporations, you have a liberty to sell your investment anytime. That's why it is called liquid investments. Whereas in the form of sole proprietor or partnerships, you have to find out a investor which may not be available readily. So there your investment is not liquid. In the securities, in the corporations, your investment is highly liquid. Okay. Now we will discuss what are publicly owned corporations or closely held corporations. Publicly held corporations, yeah, publicly owned corporations are called public limited companies. Okay. Whereas closely held corporations are called private limited companies. Okay. Let's see the difference between those two. Corporations whose shares are not traded on any organized stock exchange. In a closely held businesses, corporations, your shares are not traded on any organized stock exchange. Okay? Because there is no organized market for buying and selling their shares. Their corporations usually have relatively few stockholders. Often, a closely held corporation is owned by one individual or by members of one family. On the other hand, publicly owned corporations, there you can sell your shares through the organized stock exchanges and your investment is highly liquid. The capital stock of many large corporations is bought and sold, that is traded through organized stock exchanges. As the shares are available for purchase by the general public, these large corporations are said to be publicly owned. Okay. As we discussed a short while ago, that publicly owned corporations face different rules. What are those different rules? In comparison to sole proprietor and partnerships, they have to prepare and issue quarterly and annual financial statements. Okay, in conformity with general accepted accounting principles or international financial reporting standards, they have to comply this because they involve a large group of general public, and the public can only trust if these financial statements are prepared timely and these financial statements are audited by an independent firm of certified public accountants. In Pakistan, this mandate is with chartered accountants or chartered management accountants, or now ACCA is also coming in this field. Besides these two, they have to comply with federal securities law. This security law in Pakistan, it is managed by Securities and Exchange Commission of Pakistan. In this scenario, you have to file certain returns periodically, usually annually, about certain transactions or affairs of the business. Like you have to hold an annual general meeting at least once a year, okay? And you may call an extraordinary meeting for its members if there is a certain extraordinary activity has to take place and submit much of their financial information to the Securities and Exchange Commission for review. Okay, You have to comply with these rules and laws, and you have to submit this information to the Securities Exchange Commission. In Pakistan, this is SECP. Now let's see how to form a corporation. If you want to form a company, how you can form it. You can also form a company that is at least a closely held companies, like closely held corporations with us minimum documentation. You can form it in a day or two. First, you have to select a name, then you apply through SCCP e-portal, and you can form a company like this. You can also form a public limited company. Let's see how this can be formed. In the United States, if you are in the United States, you have to decide in which state you will form a company. In Pakistan, you have four provinces. In any province, you can form the company. It is not necessary in which province you form. You can transact business only in that province. You can transact business in any province, but for a registration purpose, you have to select a certain province or federal capital territory. The state of incorporation is not necessarily where the corporation does business. Rather, a state often is selected because of leniency of its laws regulating corporate activities. In certain provinces, maybe a certain leniency, you have to comply less documents, you have to provide less documents, and then you can form a company. But it's all depend on the regulations in which you are going to incorporate a company. Okay. After selecting a name, you have to form a corporate charter of that company. The first step in forming a corporation is to obtain a corporate charter that is called Memorandum of Association, in which you state what is the objective of the corporation, what business this corporation will do, and obviously, this should be a legal activity. From the state of incorporation, to obtain this charter, the organizers of the corporation submit an application called the Articles of Association. There are two documents. One is Memorandum of Association and other is Articles of Association. Memorandum of Association is how will the company will run its affairs with the outside parties, and Articles of Association or Articles of Incorporation means how will company will manage its inside affairs, like its board of directors, like its management, shareholders, and so on. And once the character is obtained, the Securities and Exchange Commission allow you that you can run a company. The stockholders in the new corporation hold a meeting to elect a board of directors. This is the first meeting, and it is called statutory meeting, in which all the shareholders will elect a board among themselves. They will select a certain board. Uh, they will select certain directors, which will form a board of directors. This is a special board who will transact the business of the company. This board will decide the policies and the long run vision and mission of the company, and to pass bylaws that will govern the corporation's activities. In the first meeting, they will elect a board of directors and pass bylaws, the rules and regulations of the company that will run the corporation's activities. The director, in turn, the board of directors, which is appointed, they will do hold a meeting at which the top corporate officers and managers are appointed. Okay, the first thing is to obtain a charter. Then the stockholders will select a board of directors, and board of directors will appoint or hire corporate officers to transact or to manage the business. Okay, like we have studied in the advantages and disadvantages section, that is a corporate cost. Okay, organization cost. First time when you will form a company or a corporation, you have to incur a certain cost, like attorney fees, incorporation fee paid to the Securities and Exchange Commission, or other outlays necessary to bring the corporation into existence. This type of expense is called intangible asset. Okay, this is not tangible, this is intangible, and your company has to decide that either to write off in the first year of its incorporation or to take to a further 5 year periods for income tax purposes and so on. Anyhow, organization cost is the first time expenses incurred to form a corporation. Okay, then we will see what are the rights of the stockholders. If you become a stockholder of any company, what will be your rights in that company? Okay, first thing, you will get a stock certificate against the number of shares you owns. Okay, then you have a right to vote for directors and on certain other key issues. आपके पास एक वोटिंग का राइट आ जाएगा. To participate in any dividends declared by the board of directors, you can get dividends since you have ownership in that company. As much as shares you have, as much you have a right to receive the dividends. To shares in the distribution of assets, if the corporation is liquidated, if the company is liquidated, then you will receive your shares if any residual amount is available. Okay, when corporation ends its existence, the creditors must first be paid in full. First, we will have to pay to its creditors the liabilities, the tax amount, the salaries unpaid, and so on, or accounts payable, notes payable, and any residual amount. The shareholders have a residual interest, and any remaining assets are divided among the shareholders in proportion to the number of shares owned. And this is the annual general meeting point. Shareholders meeting usually are held once each year. Okay, they have been sent an agenda about the meeting, and you can participate in that meeting. You can vote, or you can raise any question about the management and so on. Let's see what are the functions of the board of directors. We have formed a board of director. What they can do for the company. The primary functions of the board of directors are to set corporate policies and to protect the interest of the stockholders. Since stockholders select them to run and administer the company, they have a responsibility to those stockholders. The specific duties of directors include hiring corporate officers and setting those officers' salaries, declaring dividends, and reviewing the findings of both internal auditors and independent auditors. Okay, the board of directors have to hire corporate officers and setting those officers' salaries, declaring dividends, and review the findings of both internal auditors and independent auditors. Okay, now see what are corporate officers. The top management of the corporation is appointed, hired by the board of directors. These individuals are called the corporate officers. Individual stockholders do not have the right to transact corporate business unless they have been properly appointed to a managerial position. Guys, if you are a shareholder and you want to participate in the management of the company, you have to be appointed in a managerial position. Being a shareholder, you cannot do managerial position or management responsibility. You have to be appointed. You have to be appointed as a managerial in a managerial position. Only then you can transact corporate business of that company. Okay, being a shareholder, it doesn't mean that you can interfere in the day-to-day affairs of the company. Day-to-day affairs is the responsibility of the corporate officers. The top level management is called CEO or the president. Then is a CFO, the chief finance officer or controller, a treasurer, and a secretary. Let's see what are the responsibilities of the CEO, CFO. Since you are business student and most of you will become the CFO of a certain organization. So you look what are the responsibilities you have to perform there. The CFO is responsible for the maintenance of adequate internal control and for preparation of accounting records and financial statements. Today we are studying equity portion of that financial statement. Earlier you have studied about fixed assets, current assets, cost of goods sold, income statement, liabilities portion. That's these all things are taught to you so that you can prepare accounting records and financial statements. Such as specialized activities as budgeting, tax planning, and preparation of tax returns are usually placed under the CFO jurisdiction. You will be responsible for budgeting, for tax planning, and filing of tax returns. It must be your prime responsibility if you are working as a CFO. There is another position that is called treasurer. Treasurer is responsible for the company's funds and it has to ensure and he has to ensure the liquidity or the cash position of the business. The treasurer has custody of the company's funds and is generally responsible for planning and controlling the company's cash position. The treasurer's department also have responsibility for relations with companies, financial institutions and major creditors. ये ट्रेजरर जो होता है इसने फाइनेंशियल इंस्टीट्यूशन के साथ भी अपने आप को इन लाइजन रखना होता है ताकि जब भी आपको कंपनी को जरूरत पड़े तो फाइनेंशियल इंस्टीट्यूशन के साथ उसका अच्छा लाइजन हो एंड ही कैन अरेंज financing for the company and it has a strong liaison with creditors so that they can get some relaxation in payment of their dues. The other designation of the corporate officer is secretary. Secretary is a very key position. It represents the corporation in many contractual and legal matters and maintains minutes of the meetings of directors and stockholders. As we have mentioned there is an annual general meeting or any other board of directors meeting, the minutes of the meeting are taken by the secretary. Other responsibilities of the secretary are to coordinate the preparation of the annual report. There is an annual report prepared for the company, and he is the pivotal factor of that report and to manage the investor relations department and he manage the investor relations department like who is the shareholder, to whom the dividend have been paid, and so on. Any query with the shareholders agent. Okay. This is the chart, corporate organizational chart, where stockholders at the top, they select board of directors, then they select CEO or the president, and they are treasurer or vice president finance, corporate secretary, CFO or controller, vice president sales, vice president production, and vice president human relations. You can any big company like in Pakistan, you can view this organization chart for PTCL, for OGTCL, and so on. The stockholders record in a corporation. Since we have seen that you can buy your this company shares or you can sell these shares anytime, even multiple times in a day. At 10 o'clock in the morning, you can sell. At 10 you can buy it, and so on. In the whole day, there is no limit on your buying and selling. So, how we can record or maintain the stockholder register? There are specialized organizations. Like in Pakistan, there is Central Depository Company, CDC. It is called CDC. It maintains the shareholders register, stock register, or it is called shareholders register, wherein they record shareholders details, and on a cut-off date they will send dividends to those shareholders who are available in that stockholder register. Okay, now I am sending you a link for the second part of the class so that we can continue our today's session. Let's meet in that class. Okay, guys, thank you.